And we had such narrow volatility readings that we couldn't find another example that spans seven, now going into the eighth full week, where the volatility has been like off the, you would think the market is dead as a doornail. And it's sitting above these structures that we can see on momentum that look horrible. In other words, you can't, if you sneeze a percent or two, you're going to blow the whole thing. The bridge on the River Kwai goes. And yet they wouldn't break it. All they did is hug it, like they're sleepwalking along these dynamite sticks, okay? How come it went dead in the 6 to 8 weeks before the election? With this pending structure so ripe to break, it's as if somebody was supporting the market just enough, so no, not enough to create a rally, but enough to keep it from breaking down.
You're watching Capital Cause, and my name is Danny, and today's guest is Michael Oliver. Michael, thank you for coming back on the show.
It's good to be back, Danny.
Well, let's just dive in, Michael. What is occupying your headspace right now? What is front and center for you as it relates to the economy, the news, geopolitics, whatever it may be, gold, silver? What is front and center for you? I can probably already guess what it is, but I'll let you answer that.
You know, it's technical because I'm MSA, Momentum Structural Analysis. That's what we do. Now, obviously, I'm aware philosophically of certain things that are going on, but I don't let that eke into my analysis. We've been doing it for 32 years. So, but right now I see the big tectonic plates, U.S. stock market, which has been going up for 15 years, okay, biggest bubble in U.S. history by any measurement. I'm watching gold continue its upside, but not reach a point yet of any excitement at all. It's just persistent. There's this past week we had a wobble in silver and a 2% dip in gold. Okay. And so many people came out and said, oh my God, that's it. We're going to correct it. They've said this like 10 times this year, where there's been a wobble. Oh, that's it. We're going to correct it, or it's the top. And it never has been. And gold has none of the attributes of what you call a blow-off, excited, overdone market. It's just a persistent beast. And silver does it in bloody layers, but does it. In fact, it's up more than gold is year to date by 1% or 2%. And the stock market hasn't broken down yet. But by the way, it's only up 18 or so percent on the year compared to gold up over 30 and silver 35. Okay. So put that in the back of your mind. So something's going on there. We think that there's a tectonic shift, technically speaking, of major consequences where the stock market is going to give way and finally break in a way that everybody acknowledges finally. I don't think we're going to crash at any early point in the bear market. We didn't in 2000 to 2002. There was no crash. 2007 to 2009, the first crash event occurred a full year off the high in the stock market. So there wasn't even a crash event in the first year of major decline. But I think we're topping. And I think we're tiptoeing on the sticks of dynamite that will blow the support out from under the stock market. Again, I'm speaking technically using our long-term momentum technical factors, not looking at a silly price chart, which is often delusional. And usually a price chart will never tell you early on that, oh, it's a bottom and we're going up, or it's a top and we're going down. Later, 20% off the high, finally they realize. Momentum usually tells you first. And right now, momentum has started to break in the S&P and the NASDAQ 100. Full momentum breakage is literally several percent below who you are right now. So you can't sneeze or it's going to start to cave. The reason I think this is important to gold, monetary metals, is that when that market breaks, we all know, if you go back and do your homework, that that's when the data points, it might soften a bit near the top, but they really get hard negative. But once the stock market tops and starts down, that's when those data points that everybody likes to look at, unemployment, all the corporate related data points and so forth, suddenly start to snap and go negative. And wow, we're not going to have a soft landing, okay? And there are a few wise heads out there who are not technical but fundamental who've been saying for months now, this is not going to be a soft landing, and they haven't changed their tune. And I bet they're right. Uh, that breakage in the US stock market will cause a money flow out of that market to someplace else. It always does. 2000 to 2002, from 2007 ongoing through 2009, with a 1 month interruption in the middle of that bear market, gold went up during that time. Stock market went down, gold went up. So did T-bonds, by the way. So money moved out of the stock market into the alternatives. And right now, the T-bonds, while we think they are due for a spike on the upside, a nice price rally and a drop in yields, notice the T-bonds have been going down since the Fed cut rates in September. Stocks have been going up. Okay, opposite. They're out of sync. We think bonds could provide a temporary alternative for asset managers who are nervous about the stock market and start to move money. Already some of them have. It's evident. You can look at the gold market and see that. You can look at the gold mining sector. Gold mining sector, by the way, while the S&P is up 18% plus on the year, gold miners are up 30% despite the recent drop. GDX I'm talking about. So there has been a money flow already, but if you snap the stock market, a big money flow is going to start to go. Good hemorrhaging. And when that market breaks, a lot of money moves. And I think that's a point at which a lot of thought processes will shift quickly into the monetary metals. And the constant doubters that we have about every 3 or 4 weeks that come into play will just be run over. I think we're on the cusp of that, and I think maybe the election will provide the sort of outcome, and we've said over a year ago that it's going to be unpleasant no matter who wins. And I won't define what unpleasant means. It's not going to be copacetic on either side. That will cause additional shaking and rattling that will help exacerbate the downside in the stock market. And what does the Fed do in those times? They've already started the cut. We know they're going to cut some more because they're all happy with their quote inflation numbers, and their inflation numbers are based on BS metrics anyway. When they see the stock market start to break hard, they never admit it, but that is a key for them. You can go back and look at the 2000 top, and when it started to come off that top, by January of 2001, not even too far off the high, the Fed started cutting rates. In fact, they cut rates twice in that month. Did it help? No. Market still collapsed. 2007, 1 month before the top in September, just like September of this year, they cut rates half a basis point after years of rate rises and then a pause, just like we did. Had a year of rate rises and then a pause. They cut rates. You peaked 4 weeks later on the oh boy rally, and that was it. They cut rates all the way down, didn't help. What did it help? It helped monetize gold. Gold is a monetary metal. It's driven by monetary excess created by central banks and governments. And when they panic, they panic. And you can bet the Fed will panic again.
When it comes to this, let's call it capital rotation event that we're anticipating, moving from the broad market over to the monetary metal, how voluminous do you anticipate this move to be towards the precious metals?
Huge, because the T-bonds, which have been a decent, the orthodox portfolio is 60% stocks, 40% bonds. That's quote supposedly safe. Okay. Well, they learned in 2022 that it was totally unsafe because stocks went down like 25%. T-bonds went down over 30% in price. So it didn't work. But the technicals for T-bonds now are such that though their major trend is down, meaning higher yields, they're due for a counter trend rally, kind of rally that would exhibit some of that flow of money. I don't think that rally will sustain this time, unlike 2000 to 2002, where bonds went up and gold went up in an ongoing way. This time, I think you'll have a spurt in bonds, but I think most of the money's going into the monetary metals because if you look at you're a portfolio manager, agnostic. You're not a gold lover, not a gold hater. You just look at what works. And you look at what the year-to-date gains have been, despite the howling from one side that, oh, it's terrible, it's going to top. Gold miners up 30%. and the S&P up to 18. Somehow gold miners are up there. Nobody cares. Nobody believes it. More money will flow into that which is making money and has been persistently making money, not just this month, but overall during the year in an ongoing fashion. So it's literally an asset class movement. And we all know that the gold miners in particular and silver miners are a very tiny little sector. So if money does start to flow into them because of acknowledgement that gold is ongoing, that could be like a wet bar of soap phenomenon where everybody's grabbing it and it scoots. I suspect that's what we're going to see. But the main thing is Mama Gold. And again, as I said, after the 2 to 3 years of that trading range situation from mid 2020 through early 2024, gold was caught with highs all above 2000 repeatedly, kept selling it, selling it, selling it. Finally, our momentum metrics said, no, it's waking up now. It's going to launch into a different phase of the bull market. Instead of a pause phase for several years, it's going to relaunch the bull market. And it did. So we went from 2000 up to 2450, consolidated for several months, then shot up here recently to 2800. Right now we're trading 2% off that high. It still hasn't had the type of behavior that it at all can be labeled excessive, spiky, emotional. And we know from consensus that, you listen out there on the internet, and most of the analysts are looking for a top still. Okay. So there are not many believers. And I strongly suspect you're going to get a massive surge in gold and its related, silver especially, and the miners. While the stock market starts to implode, again, I'm not talking a stock market crash at this point. I think the stock market could go down in 10% layers, as it did in 2007 through much of 2008, while gold went up during that time. So that's what I'm looking for. And I think the election could help spark that because we're in such close proximity in the S&P right now to major breakage levels that I think that it's positioned itself to do so in consequence of the election.
You mentioned the stock market falling while the gold and silver prices rising in this kind of event. The conventional thinking is that when you do have a big stock, you did not say that it was a crash, but you did say that we will start to see capital rotate out of the stock market. Would that avoid a scenario where you've got margin calls and selling across the board to stop the gold price from falling?
And that margin call phenomenon has been way overdone. In fact, you had before I founded MSA in 92, in 87, I caught the crash, stock market, S&P. I did it via the same metrics we're looking at right now, quarterly momentum of the S&P, and in this case, NASDAQ 100. They both have structures that if you saw the momentum charts in our reports, as opposed to the price charts that everybody sees, you'd say, oh my gosh, you go through that, you're going to break down. But when I look at the momentum metrics, the trend factors in momentum, it looks like, you could break sharply, but likely you're going to find bounce point and another bounce point. You're not going to find a 35% drop in 2 weeks. But if you go back to 87, we had that kind of crash that literally in a few days, we dropped 35%. It involved the week prior to the crash and then the Monday and Tuesday of the crash. So like a week and a half, we down 35%. Gold went up 7% that week. Despite massive, and gold, by the way, gold was not in an uptrend at that point, a dynamic uptrend. It was sort of a middle ground, really. So, it could have easily gone down with the stock market. It wasn't strong in a sense. Yet it went up 7% during that week. Why? That you talk about margin calls, you had them then. And I suspect this time we're not going to have a crash event. I think we're going to have a layered but upsetting decline in the market, stock market. And if you go back and look at 2007, in fact, in our weekend report, we showed layer by layer of that first phase of the stock market peak in 2007 through early 2008, where you made the rally high September, October of 2007, because the Fed cut rates by half a basis point. Market rallied on that. Later in October, it topped and started down, just like we did. We made a high last month and then wobbled off the high. You started to break hard and you dropped down into January. pretty hard. No, not 20, 30%, but 15 type percent. And then had a rally back into March, February, excuse me, and it came back in March and it rallied again. So you didn't have any real collapse in the stock market till later in 2008. But during all the first phase of collapse in the stock market, gold was going up, 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 up. And so it didn't matter. The main issue for gold is monetary policy. And the Fed went tight recently. That still didn't break gold. Gold knew what was coming. Now money supply growth is accelerated again, which is not being talked about much. And they've cut rates, and we know they're going to cut some more. And they'll certainly have an excuse once the stock market starts to fracture, because other market attributes will exhibit themselves, especially data points. And that's what gold lives on. It is a reflection of the decay, ongoing decay, decade by decade, in fiat currencies. And I think we're facing probably this time around a crisis that we've never faced before, not just with the dollar versus other currencies. That's nonsense. But in the decay of the major fiat currencies in terms of their buying power and in terms of the sense of safety and ongoing stability of the public in those countries, knowing that this thing keeps decaying. When I was a kid, a loaf of bread was 20 cents. Okay. Do we have a wheat drought? No, of course we don't. We have a monetary degradation that's been ongoing for decades, and it's accelerating again. And gold knows that. That's what fuels gold.
So you mentioned the market topping as part of your analysis. What makes today different than at any other point? Because we've had multiple calls, not from you specifically, but just from previous guests and things of that nature across over the years of a market top and a crash, etc. But what makes today, this moment in time, unique?
Okay. First off, the technicals that we're looking at are mega. Okay, but first off, let's look at the U.S. stock market. We say it's a bubble. Okay. Well, everybody knows that, 29 was a bubble. Mid-70s, it was a bubble. It came down hard and even crashed into late 74. By the way, gold was exploding in late 74. Okay. Then you had another top, 2000, the dot-com. NASDAQ 100 went down 82% in the next 2 years. 82%. The S&P went down 50. Then you had the real estate bubble, mortgage crisis, 7 through 9. Net during that time, gold advanced, except for 1 month in there where it had a bloody month with the stock market. But ongoing, you look at the big trend from an investment perspective, it was an advance. And it kept going beyond that even. The bubble this time is like in time duration is 3 times as old or 4 times as old. Most of those bull markets involve 3 to 5 years. Most of those bull markets that we call bubbles had dimensions of double or triple in the S&P 500 or the Dow in terms of percent gain from low to high. So duration of years, percent gain. This time around, since 2009, the S&P has gone up 8-fold over 15 years now. NASDAQ 100 has gone up 18-fold. Okay. Now you say, well, that's because our economy's strong. Well, no, yeah, right. Okay. Look at an M2 chart and you'll see the acceleration in the money supply, and especially look at a Fed funds rate chart and what they did. Go back 50 years and look at that chart. They took rates to zero, 2008, 2009, kept them there. Yeah, they dipped up for a couple of years to 2% and took them back down again during the COVID crisis. So of the 15 years, about 13 or 14 of those years, we effectively had free money. Okay, that's called drug addiction. One of the major planks in any decision you make personally, a family makes, a corporation makes, municipal governments make in their spending plans is what is the cost of money. And if you're deluded into thinking money is effectively free, then it's a joyride. You make decisions based on that totally erroneous piece of data. And then when that finally turns out not to be true, then you made some great errors that are embedded in the economy in various millions of ways. And when they come up exposed and start to unravel, and the stock market in effect will be a reflection of that, not the cause of that. It's merely a reflection also of error being made about investments. When that comes undone, the unwinding will be worse than 2000, 2002, 2007 to 9, 1929 even, in terms of the economic reality on the street. The central bank will have to go berserk. The problem this time is there is a growing recognition that when they go berserk, that piece of paper in your pocket gets even more worthless more rapidly than it did before. And there's already an intellectual movement out there, sponsored largely by the Mises Institute, but there's a lot of economists out there who are not free market economists who are also beginning to doubt the validity of the Fed conceptually. Does it really work? It's been around for 100 years, but, it's created monetary booms and busts, followed shortly thereafter, lagged by stock market booms and busts. Do we really need this beast anymore? Is it really doing what it's supposed to do? And also if the public starts to hurt soon, and already they're hurting. We know they're hurting on the consumer side in the sense that so many data points, whether it's raw foods and stuff in the grocery store or mortgage prices or whatever, is a lot higher than it's been in recent years. And I'm not going to blame it on a president, but it's central bank policy. Once they're already being hurt by that, if they get hurt suddenly by a 20 or 30% drop in their retirement account, their perception of their wealth and well-being will drop quickly. Emotion will come into play. Right now, we don't have quite that much emotion. We have some emotion about the election, but if you inject pain due to an asset class drop in an asset that we know many Americans are now totally in love with, especially the new Americans, the young guys who have not invested before, this is a ride that'll last forever. Well, suddenly, if they get gut kicked by 20, 30% in a matter of several months, not at once, span of 6 months or so, that's a lot of pain. And if you have a lot more pain added to the already consumer problem, I'm going to bet that come tax season this year, you're going to have a problem collecting taxes. Meaning, we could well face a crisis now. We know Biden did it during the COVID event where he postponed tax payments for 3 months. You recall that because people were hurting, couldn't pay, et cetera, et cetera. If they suddenly can't pay by next April, and we think a lot of events will occur between now and then, that will hurt people, especially the retirement account levels dropping, where you suddenly get an increase in people who file but ask for extensions, way beyond the norm. Or you suddenly get a high percent of people who simply don't file and cover their eyes and hope that, oh my gosh, I hope they don't do anything. When that happens, the IRS will not be incoming the amount of revenue they're supposed to bring in. That's a big assumption by government. What's the IRS going to bring in? Well, already it's bringing in less than expected. If suddenly you pinch the public, then as a functional vehicle of income for the government's going to have to turn elsewhere. Now, if Trump wins, we already know what he's going to do. He already said, I'm going to resort to tariffs and I might even abolish income tax. Well, he might have an excuse come April. But even if it's not him, and there's a lot of pain, the IRS is not going to be a functional metric for, a functional instrument for the government. In which case, they're going to have to revert to something else. National sales tax, I don't know what. But many big factors out there that we take for granted, assumptions we think will last forever, will end. So we think this is going to be far different than any other market event in our lifetimes in terms of its real world consequences.
Can Trump actually abolish the IRS, though? What are the logistical?
Well, there's a lot of Republicans out there who are already advocating that, regardless of the events I just described. But if you suddenly create an accounting event where they're just not bringing in the revenue, they're 30% short of what they needed to bring in because of non-filers and people in pain, going bankrupt, credit card delinquencies, you name it, then the IRS simply isn't functional and they'll have to resort to something else, like print money, do tariffs, go to sales tax, national sales tax. That mechanism won't work anymore. And there's a lot of people in the Republican Party. So if Trump does win, it'll be on that side of let's abolish the damn thing anyway. So, but even if they don't win, the pain that's going to be inflicted on the public, if this stock market breaks as we expect, will be in the street type pain, just like it was in 2009. You didn't have to be in the stock market to be in great pain in late 2008 and 9. You got laid off, So it had nothing to do with whether you were in the market. This time around, there's a lot more people in the market too, so it makes it even worse. So a lot of big fundamentals that we think are norms, they've been around for a century, like income taxes or the the Federal Reserve. Uh, that's questionable. Reality could change dramatically here. And when it comes, when you flip the tablecloth off and all the dishes shatter, a lot of concepts go out the window. Now, what happens if the U.S. stock market breaks? Because the dollar right now looks very vulnerable to us. The only reason it's been rallying of late, it's gone from just above 100 up to 104. Right now, it's about 103 something. So it's, by the way, the dollar index measured versus other pieces of paper, which is not really a good way to measure its value, but is been in a dead range for a year and a half, like a 6% range. So it's nothing going on there. But we see some numbers just below the dollar, especially when you get into next year, that you drop back through that low we just made around 100, you're going to implode. Now, that's another factor that could come into play because technically it looks exceptionally vulnerable. And the only reason they've been going up is because T-bonds have been going down, yields have been rising here relative to Europe or to Japan, et cetera. And so suddenly it looks like, oh, I want to own U.S. government debt, or I want to put money, there because it's higher yield. That helps the dollar. If all of a sudden the yield starts to drop, why? Because there's money flow into T-bonds out of a sense of emergency. Again, temporary panic move of assets. Yields start to drop, and suddenly the dollar's motive for having risen evaporates overnight. So right back down again. So there's a lot of big factors out there that are on the edge of major moves. And I think the stock market is the one to really watch right now. I don't care if you're in it or not. If you're in gold only, watch the stock market because it's your next refueling for gold.
What assets tend to benefit slash get hurt by a Trump presidency versus a Harris presidency? What are the baskets of assets that work?
I almost don't think it matters because I think these events are going to occur. And I know while a lot of Trumpers think he can magically come in and change reality and take us back to a less government spending and so forth and so on, there's a crisis ahead. The crisis has been building for decades. It's not something he could come in and push a button and stop. Javier Milei is an anarcho-capitalist who was elected president in Argentina, a year ago. He upset two major parties that had been in power, rotating just like Democrat Republicans for decades. He didn't even have a party, and he blew them out. He's now president. He warned before he came into office, I don't know if Trump will do this or not if he gets elected, he'd be wise to do so, that there could be hell to break loose even though he gets elected. It has nothing to do with any virtues he might have that some people think he might have in terms of reducing government spending, et cetera. There's too much stuff that's already occurred that needs to be expunged, no matter who becomes president. So the downside I've been describing in terms of stock assets imploding is likely to occur regardless of who becomes president. Hence, public panic, hence movement of assets. And, even if you view him as a magician who can fix all this past stuff, he can't do that at a point, button. And Javier Milei in his speech said, listen, guys, this could be very bad stuff happening, even if I win. He was wise to warn because there is. And, that it's going to happen anyway. So I think the outcome of the election is a provoking event in that it'll create a sense of political instability. I don't think it's going to create stability in terms of outcome. And that alone could add to the factors that I'm talking about that are about to unfold anyway, based on a bubble that's breaking, so that could exacerbate the event, speed it up a bit. Now, I don't want to get into a conspiracy theory here, but we had a report a week or two ago where we looked at the S&P 500 daily action, day to day, which we don't normally look at. And we have momentum metrics that measure volatility, just like everybody looks at the, the VIX index and all that stuff. But we've got our own unique methodology. And we had such narrow volatility readings that we couldn't find another example that spans 7, now going into the 8th full week, where the volatility has been like you would think the market is dead as a doornail. And it's sitting above these structures that we can see on momentum that look horrible. In other words, you can't, if you sneeze a percent or two, you're going to blow the whole thing. The bridge on the River Kwai goes. And yet they wouldn't break it. All they did is hug it, like they're sleepwalking along these dynamite sticks. Okay. How come it went dead in the 6 to 8 weeks before the election? With this pending structure so ripe to break, it's as if somebody was supporting the market just enough. So, no, not enough to create a
Interesting.
rally, but enough to keep it from breaking down. Now,
Hey guys, quick pause. I won't take too much of your time, but if you're looking to add into your gold and silver stack, please consider Miles Franklin. More specifically, email them, info@milesfranklin.com, and tell them that Capital Cosmos sent you in the subject line to unlock special pricing that you won't find on the website. In the unlikely event that you don't like the prices, you could always not buy. There's no commitment necessary, but I do recommend Miles Franklin for a number of reasons. The customer support is top notch, the prices are great, and I know the people there. Great people all around. So with all that said, let's get back to the video. Thanks,
I
guys.
have no idea. All I can say is it was bizarre volatility readings, the likes of which I can't find an example of spanning that amount of time for daily momentum. Now, if we start to break these numbers and we're moving toward doing that, that volatility is going to pick up again. Of course, at that point, it doesn't matter. Whoever might have been supporting the stock market won't matter because the election's over at that point, if in fact that was going on. We know that governments do support markets and fight markets historically. We know this, the repeated examples. The COVID event, the government came in, supported the market. They bought, ETFs. The Fed bought ETFs. The gold bull market in the 1970s, late 70s, the IMF came in and dumped gold, dumped gold, dumped gold. Did it stop it? No. It just compounded the explosion. There's many times when this has happened both ways, supporting something, resisting something. And it never works, but it can delay things. So anyway, we're in interesting times, and I think probably after the election, the events are going to speed up.
I see. What of the price of oil and all this? We you have talked about the collapsing stock market, the rising precious metals prices, but what of oil?
Oil is doing just what the Bloomberg's done. MSA called a major bottom. We call it a commodity explosion in October of 2020. At that point, oil was down on the sewer, natural, everything was down low. You name it, grains, energy, it didn't matter. You could throw a dart, they were all depressed. Bloomberg Commodity Index was coming up from its low at $58, and it was above 70, and we said commodity explosion. Well, in the next year and a half, between then and February, March of 2022, it went up to 140. Everything went up too. Oil went up big. It went up to $130. Natural gas went to 10. All the grains went up. Everything went up together. The leader during that time was the energy complex in terms of what sector within commodities outperformed, and it was the energy complex. I'm not betting on that this time. This time, the Bloomberg has been basing for a year and a half. In fact, you can look at a price chart and see that the, quote, subduing of inflation actually began a year and a half ago. The Bloomberg got down to 100 from its 140 high, and it's been oscillating either side of 100 on the Bloomberg, which is about a 50% correction back to its bare low from its March 2022 high, dead as a doornail. Right now, it's 98 and a half, okay? You're where you were a year ago, unchanged on the year, okay? It's the most dormant category out there. In other words, all the fighting of inflation hasn't taken it down anymore. It had already come down. And you can see on price a likely basing. But when I look at momentum, it's even clearer. It says, no, this is a basing pattern, and there's highly likely to be another up leg. Because commodities are still cheap. By that, I mean, if the Bloomberg's at 100, and you go back and look at the 2008 high, it was 280, I think, or something. And at 2011 high, it was 170. So right now at 100, it's still cheap historically relative to the prior highs. Like gold has taken out those highs, Bloomberg's halfway back there. It looks like it's basing and ready to turn up, but this time I don't think energy is going to lead it. I think energy will participate, but I think more likely you're to see grains lead the move this time on a percentage basis. So yeah, energy is likely to participate, but I don't think it'll be the leader.
Is that unprecedented? Doesn't energy usually always lead, followed by the rest of the commodities?
No, not in my experience. No. I think copper will do well too, but I think the grains this time, which have been beat up far worse, by the way, than the Bloomberg has over that year and a half,
Mm-hmm.
2022 to 2023, uh, it went sideways halfway back to its low, whereas grains fell much further back. But they look like they're basing in unison now. I'm talking corn, wheat, and beans, and they look like they have more potency to go up on a percentage basis, more so than oil will. But I do think the old complexes is ready to move together again in unison, which means what? Well, it means that in terms of asset categories, if you're an asset manager, well, they don't buy commodities as such. We know that. But look at fertilizer stocks, agricultural related stocks, energy related stocks. They are not behaving whatsoever over the last few years as the S&P 500. They're in their own world, and they reflect the Bloomberg Commodity Index. So if in fact we're correct that that's a cheap asset category, and when asset class movement begins because of the breakage of the stock market, that money will go somewhere. I could see a lot of it going into commodity related stocks. Again, fertilizers, ag related companies, so forth and so on, energy related, which are behaving quite steady, by the way, steadier than oil even. Uh, out of the stock market. So the stock market breakage will help fuel them. But also, if an upturn occurs in commodities, what could help sponsor that, aside from the fact that a simple money flow into a cheaper category, historically speaking, a cheap category? The Fed starts to print again, as indeed they are. Money supplies are at a 23-month high right now. If they start doing that again out of panic, the money goes somewhere. And if you look back in the mid to late 70s, it went into commodities and gold, while the stock market was an absolute total wasteland. So that's a category to look upon favorably. It's not going to beat gold, but it'll probably lag to and follow gold. And it's not always in sync with gold, by the way. Commodity movement, like for instance, the Bloomberg made a low in 2015 with gold. Gold doubled between 2000 then and 2020. Bloomberg continued down through 2020. And when Bloomberg doubled from late 2020 to 2022, gold was in the correction mode. But now I think they're back in sync again. So the next gold upside is likely to reflect that, again, the asset class movement out of a broken category, stock market, and into cheap, lower risk, higher reward categories, commodities being one.
Interesting. What about the mining stocks? You do have this kind of subdued oil price with the backdrop of rising gold and silver prices.
Yeah.
Shouldn't their margins be increasing, and therefore, should we be seeing more than kind of these modest gains?
Yeah.
We've been seeing as well.
I don't examine the fundamentals of the companies. We try to avoid that because that's fundamental analysis. And we know that's difficult. And it ebbs and flows given this miner or that miner. It doesn't necessarily have to be reflective of the whole sector. We know recently Newmont took a big dive. Okay. We said buy it back in April at 40. It's now 45, 46, and a big drop, but it's still well above its entry point. But many of the miners didn't break recently. Why? Because it was peculiar to Newmont, and Newmont was 14+% of the GDX. So no wonder GDX dropped $4. It's 14% of it plus is Newmont.
Right.
But that sector, everybody seems to think it moves with the stock market, and they're making the mistake of going back, let's say, to 2015, and they overlay an S&P and they overlay the gold miners, and they overlay gold, and they say, well, they've been in sync together. Well, yes, they have, but that's occurred in the past too. But then they've divorced at times where gold and the miners continue up and the stock market breaks down. Okay, so when the stock market topped in 2007, do you think the gold miners topped in and went down? No, they continued up through 2010. Yes, they topped before gold, which is probably an early warning, but they went up for several more years despite the stock market being cut in half. Okay, so don't make that mistake. They will reflect Mama Gold. Mama Gold's going up, they're going up too. And after all, again, GDX, even with the recent drop, is up 30% on the year compared to the S&P up 18. So which category's done better?
Right. Well, I think we've covered pretty much all I have down here, Michael. Anything you want to talk about that we didn't get a chance to before you wrap up?
No, I just think that the gold market is not to be confused with stock market direction at this point. In fact, the stock market breakage is something we've been arguing for months, and it hasn't happened yet. Where gold reignited itself in March. We put out a renewed buy signal at 2,100, and silver just above 25, and GDX at 31.5. That was our last major buy signal. GDX is at 40 right now, silver is 32.5, and gold's 27.50 compared to our entry levels. Don't confuse it with the stock market. It can continue while the stock market peaks. In fact, during that period in 2007, when the stock market rallied during the Fed cut, gold rallied too. So they looked like they were in total sync. And suddenly, when the stock market peaked in 2008, and by the first quarter of 2007, in the first quarter of 2008, it was well off its high. Gold had continued on up sharply. So I think we're at that point again. So don't confuse the stock market with gold. In fact, we argue the breakage of the stock market is the next major refueling of the gold market.
I see. Well, hey, Michael, where can people find you?
OliverMSA.com.
Excellent. We'll have the link to that
Ask for
down
some
below.
sample reports, and happy to send them.
Okay. Yeah, we'll have that link down below in the description box. So be sure to check it out, guys. If you enjoyed this video, give us a like, comment down below. Go, Michael, go. If you disagreed with anything we had to say, let me know what it was. I do read the comments, and I'm really interested to get your takes here, guys. And also subscribe to the channel if you're getting value out of these videos. And also check out our Substack, capitalcosm.substack.com. A link to that is down below as well. Check it out to support me in other ways. And with all that said, I'll catch you guys in the next episode. See ya.
Thanks, Danny.